G'day expats and welcome to another episode of Expat Chat, episode 82 today. And we're marching through the year. It's, what are we looking at? Almost halfway through April. It's just scary. I'm still getting used to writing 2023.
I
Joined on the
know.
call today is best mate, colleague, business partner and guru for the APAC region, James Ridley. G'day, James.
G'day, Brett. What a terrific way to kick off the episode there, mate. And for those that are tuning in and only listening to us today, obviously always joined with my co-host, best mate, and a work partner and colleague, Brett Evans, who is the guru in the Middle East, Europe, and Africa's region. And if you're obviously watching us on YouTube, a couple of heads for radio at the moment. But Brett, how's everything going in the Sandpit? I know you've had a busy couple of weeks with those school holidays.
Mate, thanks for
Settling back
inviting me
down
back.
now.
You and Mitch are doing a good job, so I thought I've lost my job.
Well, we thought about it. I'll be honest. I think. Oh,
Yeah,
I think Mitchell's a little bit dirty that he's not on today.
yeah.
But that's okay. I'll calm him down.
The seat, he's getting a bit comfy in that seat. So, mate, all
That's it.
good here. School's back in swing. We haven't hit the summer period yet, which is good. You know, the weather's still pretty nice, so I'm
Mm,
enjoying that.
yeah.
Interesting to note, this place is just teeming. It is just
Yeah.
flooded by people. You know,
Yep.
there's just the roads are full, car parks are full, shopping centres are full, schools are full. You know, it's really teeming. So it's funny how, you know, when you sit in a regional hub area and you get to look around and see what's going on in the other countries and stuff, and there's certain things we're experiencing like others, and there's certain things we're not. You know,
Mm.
and I guess that's the benefit of earning a US dollar equivalent currency. Yeah, we sort of export our inflation as opposed to experience
Yes.
it. So yeah, when the Australian dollar and the pound and the euro go down, yeah, we're actually pretty happy about that.
Yeah, I mean, yeah, currency, you look at it right now, it's currency wars, I guess you could say.
It is.
Australian dollars, it's come off a little bit in the last couple of weeks and God, we hate it, but that's just the way things are. And I think that's probably just currency traders probably pricing in another interest rate increase or cash rate increase happening in the US very, very soon. Um, but mate, as always, we're good at digressing away for today's topic. I want to have a chat to you about tax concessions on property. And the way that I want to layer this for our listeners is firstly what you get as an Australian tax resident versus what you don't get as a non-resident. You like that
Yeah.
swivel?
Yep. I like that. That's good.
And just being mindful of when we are investing in property, okay, these are the things we no longer have access to, but we still need to be mindful of, you know, potential capital gains tax events in the future, mindful of strategies around that. Before we get into it, as always, bit of a disclaimer, and I'll do the jingle today.
No, your job now. You
Today,
kill it.
that's right, mate. Today's episode contains general information only and should be taken and consumed for entertainment or information purposes only. The information contained in the episode is not a recommendation and therefore should not be relied upon as any form of personal advice. If you do need assistance or personal advice, please feel free to reach out and we can assist. Jumping into it today, tax concessions. I mean, firstly, what are tax concessions, Brett?
Right, essentially, they're a bit of a gift, I guess is the best way to
Mm,
describe it. So
mm,
we all work under a regime there that taxes are applied, whether it's capital gains tax, VAT, all those things. So when there's a transaction or an event, you know,
mhm,
the appropriate, you know, taxes is applied to that. Concession is when you either don't have to pay it or you get a discount. And
mm.
we all know that in Australia, property is a religion. And the reason why property is a religion in Australia is because pretty much tax concessions are handed out like lollies when it comes to property.
Yep.
So
Yeah.
that rod has been made for Australia's back over the last 20 years, and we are in the current situation we are because of all those concessions.
Yeah, that's right. And I mean, and I'm not going to get political or too political, when we look at who's in power right now, Labor, we know that they want to wind back a lot of those concessions, whether it's to do with property or franking credits or other things. So I'll say this, it's going to be interesting to see what happens with Labor in power if they stay in power for the next couple of terms. But that's exactly right. It's a bit of a free gift for owning certain assets for different periods of time. Some of the credits that we get, discounts that we get when paying taxes, even discounted tax rates as well, depending on how you layer it. Well, with that in mind, let's talk about property. I mean, we know as a normal Australian tax resident, your home that you buy and live in forever, it's a tax-free asset. When we sell it, it's also a tax-free asset. And I guess what we're referring to there is that main residence exemption. And I mean, and we'll deep dive into that a little bit soon, but the benefit of that main residence exemption on the surface, zooming out, is just the fact that you can own a property, live in it for 15, 25 years, sell it, move to another property, downsize, and that's a tax-free transaction. There's no tax for moving. The only, I guess, indirect tax is stamp duty, depending on the states. We're sort of the only country that loves doing that, unfortunately. But with that in mind, that's what the main residence exemption is. The other opportunity that you get as a normal Australian tax resident with the main residence exemption is that temporary absence rule. And that's that 6 years of relief where, as an example, Brett goes out, buys a main residence in Australia, lives in it for 3 years, wants to move interstate down to Sydney, he can then rent out that former main residence for up to 6 years without any capital gains tax applying to that growth. If Brett actually moved back into that property before the 6 years were up, he's technically done it in the right manner where he could live in that property for another 5 years after that, sell it, and it would be tax-free because he hasn't blown through that 6-year temporary absence rule. So we're talking about this as a traditional Australian tax resident. Conversely, non-residents, expats, our mates, they don't get it.
No, and that was the big dramas we had leading into the 2020s. From 2017 through. 6-year rule was a word. I mean, it's funny how everyone knows about the 6-year rule. They're not sure what main residence exemption is, but everyone knows about the 6-year rule. And
that's right.
It's been a mainstay of expats managing their assets for many years. But 1 July 2020, that was gone.
Yeah, exactly right. They acted pretty swiftly. I mean, they gave us the heads up, 2017 budget, and then didn't hear too much from them, the government, for a little while. And then finally, the announcement came out December 2019. Expats, they had 6.5 months to act pretty quickly. And I think there was always a bit of confusion around, whether it was the signing of the contract or settlement at that time as well. You could sign the contract before 30th of June, but it could settle after the end of the financial year. But it put expats in a very difficult situation because that's right. You also had COVID. You had COVID going on, and the property market was going through this very unusual period in the first 6 months because rates hadn't really changed too much. So it was a difficult period to sell. Capital was drying up. People weren't just buying property or selling property because the fear of the unknown with COVID. It's just like the stars unfortunately aligned for a terrible and disastrous situation, which unfortunately played out for a lot of expats, faced with a difficult decision. But yes, main residents or non-residents can't access the main residence exemption anymore. It's actually quite baffling. I'm having calls still with a lot of expats that weren't even aware of that. They go, oh, we thought we could sell our home and we wouldn't pay tax. I was like, no, you haven't lived in it for 3 years. You've been in the US or Singapore. You actually don't get any tax relief on that property anymore. You pay tax on the capital gain all the way back until the day you purchase it. And the tax rates are punitive because you're a non-resident, 32.5%, 37%, 45%, very punitive. So always make sure you're doing your research there and seeking advice if need be. And that's a good way to sort of probably wrap up the main residence exemption. What are the other concessions that Australian tax residents get, Brett? What's another main one?
50% capital gains discount. You have an investment property, it goes from $1 to $2 over 10 years. As an Australian tax resident, when it comes to paying the capital gains tax, you can cut the tax bill in half and then you apply your marginal tax rate to that 50% of that gain.
That's right.
Unfortunately, as expats, we don't get that love either.
No. I mean, as we know, that was removed, May 2012, 9th of May. From 9th of May, no longer applies, unfortunately.
Yep.
And it creates some, it creates some confusion when expats are selling investment properties because you do need to seek a valuation, a market valuation from an independent valuer. And a lot of the time, the valuations that are often sought are from real estate agents and
appraisers.
That's it. So appraisals can help to do some hypothetical modeling because they can still look back into historical sales in the area and those sort of things. But the one thing to be mindful of is that most accounts will want a proper valuation done, some sort of formal report, and usually needs to be coming from an independent valuer. But again, you can't apply any discount concession after May 2012 when you're selling that property. So it can be very punitive. And ideally, if you are selling a property, a lot of the capital growth might have been in the first couple of years up until May 2012 and then not too much after. I think when you look at different suburbs or different areas around Australia, that's probably a really good example of probably the Perth property market. Perth property market went through a very early boom through early 2000s up until probably 2010, 2012. And then after that, it hasn't done too much since then. There's been very mild, small capital growth, but nothing like, your majors, your Sydney, your Melbourne's.
Yeah.
That's it. So it really depends on the market that you're selling in, but that is a concession that you can no longer access. And I mean, I often get asked the question, but when I come back, James, and I sell that property as an Australian tax resident, I'll be able to discount that gain, from the day that I purchase it, because at the time I'm selling, I'm an Australian tax resident. That's not the case. It's going to be prorated. Exactly, yep. Prorata. And that's why a really good, I suppose, tax compliance is seeking a market valuation just after you get home on, the investment properties. That way you're helping segregate those different.
Yeah,
exactly right. But that's a common one. A lot of expats or Aussies, they just assume that if I'm selling it as a normal Australian tax resident, I can apply the discount for the whole period. And I have no doubt that anyone that's done their own tax return in the past that has thought that they've got that very wrong.
Yeah. And the other one I said to someone earlier this week, and he was a bit bemused when I explained him. He's a new, about to come out of Australia, moved to the UAE. Welcome him to the brethren of Aussie expats in the sandpit. And I was explaining how you manage your assets as an Australian tax resident is different to how you manage your assets as an Australian non-resident. And I made the comment that when you're a non-resident, you actually don't want your property to change in value. And he goes, why is that? I explained how, any change in that value while you're away, you got to get stung at 100% on the gain. So he goes, well, I was talking to someone just recently. I'm actually looking at doing a renovation of the property in 12 months' time after I get a bit of cash flow. And I said, well, that's actually the worst time to do it, because you're changing the asset value most dramatically. If you're spending 100 on a reno to make 200 grand on the gain, of that 200, you'll be losing 100K in taxes. Whereas I said, if you did that when you got home, you'd only be paying tax on a half. So it's 100. So really 50 grand is the cap out. So I said, just by deferring that renovation for a couple of years, you've just saved yourself 50 grand in cash.
Yeah, that's right. And that's probably a lot of expats wouldn't be aware of that, where when you're adding significant value while you're away. Yeah. And then you've got to remember that is naturally going to increase the value of your property. I dare say if you're going to own the property, you'll go back and get a bank val and go, cool, I've just added 250.
Yep.
You've added 250 probably not at the best time, because as Brett just mentioned, you can't discount it at all, whereas it would have been more fortuitous to do it when you are back as an ordinary Australian tax resident. So that's a really important takeaway. The ATO's
got their hand in your pocket. And it's funny how we especially in sorry, I didn't mean to cut you off. In the Middle East here, we have so many spruikers trying to sell property and renovating and all that sort of stuff. But these people aren't licensed in terms of financial advice, so they don't care. They don't care about the ramifications. They'll say, oh, you can spend this much and do this much, and wow, you're in the Middle East, you're earning big bucks and no tax and all this sort of stuff, and you're putting money to work. In actual fact, you just cut everything they say in half because there's no value there.
No, that's right. And I mean, a lot of the time you hear of probably the property spruikers, not putting too much shit on them, but
they got a job to do.
A lot of their strategies are derived from negative gearing. And I guess, and if you're only investing in property for the negative gearing, which is giving you a tax refund, well, you're an expat, so you don't get tax refunds. So just bear that in mind. But let's talk about negative gearing on both sides. So negative gearing, I mean, as a normal Australian tax resident, it can be a useful strategy, especially for a high income earner, because one, we can support the cash flow on that. And ordinarily, it means that a property is negatively geared from a tax aspect, when we factor in the interest expense, the council rates, the insurance, and lastly, probably the biggest and juiciest tax deduction is the depreciation. Depreciation is a double-edged sword, though, and I'll touch on that shortly. And by way of doing that, it's reducing your wage income, which is taxable, which means at that level, your employer's actually paid too much tax on your behalf. So you're entitled to a refund. And, depending on obviously your income level and how much the negative gearing is, you'll get a juicy refund and should be using that wisely, invest it, pay down debt, all those sort of things. So that's part one. As an ordinary Australian tax resident, can be a very useful strategy. And I'll say that under negative gearing, there's multiple other strategies that sort of cover that blanket. When you look at a non-resident, a non-resident or an expat, they're based overseas. They ordinarily won't have an employer here in Australia paying tax on their behalf. So a property isn't really negative geared to the right property strategy. You'll get the losses though, which will carry forward. So technically, we can say that an expat does get the benefits of negative gearing, but it's a delayed gratification or delayed strategy where the income, the losses, they'll build up on your Australian tax return. And then at some point, you'll get to use those in the future as the property unwinds, it becomes positively geared, or in the first year that you return back to Australia. Often you'll hear expats refer to losses as tax credits. That's not correct. That assumes $1 of loss is equivalent to a dollar worth of tax, but we know that's not true at all. It's just losses, income losses. They're not credits, and there's often a bit of a huge differential of what they actually mean. And I think what we often see is people forget to do their tax returns, so they actually don't know what their position is on those properties as well.
Yep, and I think that's a great point. And when you're having these conversations on a daily, weekly, and monthly basis with clients, that education piece is important because I've got one client, he's got 5 properties and just bought them because he thought he had to and doing the right thing. And he was sold on the premise that he's building up tax credits, and then he can apply these to anything and everything under the sun. I said, no, they're an income item. You can only apply them and offset them against income. But I said, let me rephrase this. I said, how much out of pocket are you a month in topping up these mortgages? And he said $6,500 a month. He was having to put in to keep these 5 properties going and keep a bit of a cash buffer. And I said, okay, so you're overseas, how long, much longer? Maybe 5 to 10 years. So 6,000 a month times it by 12 times it by 10. That is money. That is money that you're getting nothing back on. And then you may get that back, should you return to Australia and start, earning a salary, and you can offset that against your income. Or if you decide never to go back, or when you do go back, you're retiring, that's gone. Like that money you shelled out on a weekly and a monthly basis, you never get it back. So it is to me, yes, you're paying money out to get it back, hopefully down the track. But in that period of time, it's like giving a stranger your cash and say, just hold this for you. And I may ask for it back later on. You're not getting any return on it. You're not getting any. So it's always important to look at a cash flow of a property as a non-resident to make sure that the premise behind buying the property stacks up as an investment, not from a cash flow point of view. So, absolutely. And otherwise, what's going to happen is this thing's going to be a noose around your neck, and you're solely reliant on the premise that getting this money back, not is that property a good property to buy, and is it going to go up in value?
That's it. And it's a really common one where negative gearing, it makes sense, but I guess, and depending on your situation, but if you're looking at buying a property where the main return to you, especially over the next 5 to 10 years, is just refunds from tax, well, that's probably not a good investment and decision matrix to buy that property. As a whole, we know that solid investment properties, good areas, good infrastructure development, low vacancy rates, not in a derelict suburb, doesn't have a lower socioeconomic demographic, because that means there's going to be significant wear and tear on the property. There's a lot of factors that go into a good long-term hold when it comes to investing in property. But I mean, that's just a good high-level example there of a few of the concessions and on both sides.
And it comes back to that episode 79 we did, is now the time to buy Australian property? The answer is depends. If you are about to repatriate to Australia and you need to buy a property to move into, if you're shelling out $2,000, $3,000, $4,000, $5,000 a month to cover the gap, it's okay because you're about to move into it anyway. But it all comes back to ROI. And you need to look at the net tax position of any transaction, property, shares, wherever it is. Doesn't matter what it is. What's the net tax position? Because you look at the gross number, it looks pretty cool. But if you go through and look at the net and say, okay, I'm going to take on this much debt for this much return, then only you can determine whether that's appropriate or not.
That's right. And that's a good segue and a shout out. We've got our property webinar coming up on the 25th of April. We'll drop a link
down below.
So you can, that's it. So you can register. I'll have Brett and Jeremy. Jeremy's obviously director of the Atlas Mortgages side, just giving his insight into what he's seeing right now in the mortgage market, where rates might go. And then obviously Brett's sitting on there as well, giving 2 cents on the property market and probably what we might see, especially from a lot of the data coming out of ABS and APRA. We love those data packs, don't we? And just giving some insights there as well.
Yep. No, I think, as we've told everyone before, we're impartial when it comes to whether you should buy not buy property. We don't get commissions and those sort of things. So we're happy to call a spade and give everyone just that raw, unemotional, information to help them make informed decisions.
That's right. Absolutely. In the meantime, mate, that's been a good wrap up today. I'll see you on the next episode. Thanks for tuning in, guys.
Thanks, mate. See you soon.